So Prashant, just a follow-up question to the number of stocks that you went a lot of depth. There's a question which says that they agree with that not to have self-interest restriction on number of holdings, but at the same time, how would you ensure that the contributors in the portfolio have meaningful impact, meaningful allocations enough to make an impact in the portfolio?
Can you repeat the question again, please?
Sure. Basically, having a small allocation, how would you ensure that the contributors in the portfolio have meaningful allocations enough to make an impact to alpha and returns?
So obviously we are giving the evidence here, and I don't know whether my screen is still visible.
Not visible, Prashant, you can share it again.
So how would we ensure is like, that's our job, right? I mean, we have invested now Coforge or Naveen Fluorine, for example. We would have invested, if I recollect correctly, initially a 1% position. I did mention that at Goldman or my prior firm, I'd started with even a 30 basis points position. And even there, it has had a big impact, even with a 30 basis point position. And your 1% has gone up by 460% from our initial purchase. And it has contributed 500 basis points to alpha, 5 percentage points to alpha. Yeah. And, some positions could be even smaller than 1%. And it is like every position size individually, if they can add even 20, 30 basis points, and it adds up to a very large number. It's like, some batsmen score through sixes. Yuvraj hit 6 sixes and he's great and remembered for that. And he's a star batsman of India team. And Dravid scored most of his run through singles and twos. And he's done extraordinarily well for India as well. So it's different. Managers have different style, and we believe our style is more sustainable in that a lot of these singles add up to a good large impact. These Naveen Fluorine happens to be a name where the impact, because it went up 5-fold, the impact is that much larger. But even if Naveen was up, a tenth of it, and had contributed instead of 500 basis points, if it had contributed only 50 basis points, that's also very good. If we have 20 names are contributing 50 basis points, so let's say we have in the portfolio in small caps right now, as we'll see, we have a 20 name portfolio in small caps that make up 16%. So that's like on average 80 basis points position. And we're not at all shy of highlighting this. We think it's a great way of investing in small caps and maximizing your alpha by investing in smaller names than what you could if you had only an overall total portfolio of 20 names instead of 67 names. So you can think of it as a 21 name concentrated portfolio of small caps we have, if that helps. And an average position size instead of 80 basis points is 6 times that, which is nearly 500 basis points, because 21 into 500 would make it 1. So we have a small cap portfolio where each position size is very meaningful, if that helps. And then collectively as a small cap portfolio, they've delivered very strong returns, as we shared with you a number of times, including earlier during this presentation. So the positions are meaningful enough to have had the impact on the portfolio.
Sure. Thanks, Prashant. Maybe I'll ask the next question to Parag and then come back to you for some other questions which there are. So Parag, given that you cover financials, would love to hear your thoughts on the finance sector, whether this is the golden period for the Indian finance sector.
Well, yeah, I mean, even if you go past a year or so, FY23, all the major line items, be it loan growth, be it margins, I'm talking about the lending financials, be it loan growth, be it margin, be it asset quality, all of them were, almost at the, best throughout the decade. Now, as going forward, I think, there will be some softness in a lot of these parameters from the, best time which they've seen. I think loan growth can come off by around 100, 200 basis point. Margin may remain flat. I mean, FY23, we've seen actually almost 50 to 75 basis point margin improvement. That may take a breath. But I think overall, if you look at our top holdings, especially for the banks, they should kind of grow at 17-18%. The margins would broadly be flat, and there will be a profit growth of again 16-18% over the next 2-3 years, and the ROEs will also be very strong. So I think good times will continue for lending financial. Very briefly on non-lending, I think especially the insurance sector, given the tax changes, I think the growth will base out broadly in this year, and slowly the things will start improving from the second half of FY24. But yeah, I think even in the insurance sector, the next 1 or 2 years looks very promising.
Sure. Thanks, Parag. So Prashant, back to you. And there are numerous questions, and I'll summarize them. So essentially, the questions being asked is, between investing between a flexi cap mutual fund and a multi-cap PMS, in which is better, and in particular, between the Pioneers PMS and our own flexi cap mutual fund, which one should one look at, and what could be the potential differences?
Certainly. So again, we would, I see a lot of, maybe we can note down the names. I see a lot of email addresses for the Peter Lynch book. I don't know once the session is closed, whether we would lose those messages or we would have those messages, but we should otherwise try and record those messages and arrange for the book to be sent. Thank you all for sending these messages. But to your question, see, we believe both would do well. And we've obviously answered this. We've got this question over the last 12 to 18 months, number of times since we announced. The FlexiCap mutual fund is going to be run as a mutual fund, and FlexiCap PMS is run as a FlexiCap PMS. There are going to be some differences, and that is what the question is. So in FlexiCap mutual fund, the target client base is the retail client base, recognizing the risk tolerance of the retail client base. It may have certain names in the portfolio that are very large names in the benchmark, but from a risk perspective, would still be owned in the portfolio, even though some names. So let me take a specific example. In case of energy sector here in PMS, we own 0. Yeah. But I believe in our FlexiCap strategy, there is some exposure to energy sector. And the largest market cap companies in the energy sector, while FlexiCap might be underweight, but it is not 0. I believe the FlexiCap owns some weight in the government-owned banks, some of the largest government-owned banks. We in PMS do not own the largest of the government-owned banks. So the risk calibration is to a different audience or different set of investors in FlexiCap mutual fund than it is in FlexiCap PMS. In certain years, FlexiCap MF would do well. In other years, FlexiCap PMS might do well. It's hard for me to say over a long period of time which one would do better versus the other. I would say that FlexiCap MF would likely have lower risk relative to the benchmark because they have more benchmark awareness because of the reasons that I just told you and the examples that I just gave you of them owning some of the energy names and some of the government-owned banks, which we on the FlexiCap PMS side do not own, as we believe our investors can tolerate somewhat more volatility in performance relative to the benchmark. I don't know whether it's right or wrong, but that's our belief.
Now, the next question is, what's your general view on the markets? And given that you manage global money from global investors, what are their views for the FI sentiment towards India?
Certainly, that's also, as I'm reading through the questions, there are a lot of questions around that. Yeah. And while we didn't get time to cover this, there are questions. While this graph was in a different context. But look, we have been getting a lot of questions that over the last 2 years or 1.5 years, fixed deposit has given better return than equities. Now, 1 and 2 years is a long time period, right? Any to investors, anything that is beyond a few months is a long time period. I hear on CNBC sometimes they ask the people call in to CNBC and say, "Can you give me a idea for the long term? I'm a long term investor. My investment horizon is 3 months." And so for many people, 3 months is a long term investment horizon. And I think for a lot of investors, lot of investors, 1 year is long term investment. Now I think you are here on the call because you invested in equities, and I assume you believe equities over time deliver superior returns to fixed income. But there are sometimes prolonged time periods when equities give weaker returns than fixed income. And this year chart, if you see on the left-hand side, starting from December 1991, and the chart is incomplete actually. We'll have to do a complete job, but starting from 1991, it would have taken till December 2005 or something for equity markets to outperform fixed income. Fortunately we haven't seen any such time again, because the 1991 was a very high point because of Harshad Mehta scam, and the 2003 was the low point. And so for over a decade, the fixed income did not give return. Yet at any point in time, if you'd asked me during that time, what is the right investment, I would have said equity markets all along. And then that's how I've been investing. There have been other periods like 2010 to 2012, or somewhere late 2009 to 2012, where equities gave negative return, whereas fixed income gave positive returns. And now also, since some point in 21 till now, equities have given inferior returns. And by the way, what I'm saying here is also true for some of the questions that are here, that for the last 15 months you have not outperformed, or 18 months we've been invested and you've not outperformed and all. Our outperformance, as much as we would like to come every year, it is just not practical expectation for ourselves, unfortunately, as much as we would like. Just like equities, over long periods of time, it's reasonable to outperform fixed income. But you see periods of 3 years, 2 years, or even a dozen years, which hopefully would not be the case. But there are several periods, even from 2006-7, there are several periods of more than a year or 2 years where equities have trailed fixed income. And once the graph is done more correctly, it would be even longer, because I can see on the graph longer time frames but not properly captured, and hence I didn't go through this graph properly. So that is the way the equity markets are. If equity markets could outperform fixed income every single year, then nobody in the world would have ever invested in fixed income, because then there would be no risk in equities. Equities have risk. They are expected to return higher than fixed income. So the point of how do we view going forward from here, if you ask me pretty much at any time this question, I would say Indian equity markets, just like it is true for any equity market in the world, and you can look at the empirical evidence, it's pretty close to what I'm saying. The right expectation going forward is that equity markets would generate returns in line with nominal GDP growth of the country plus the dividend yield. And there is some underlying logical basis to that. Yeah. And that has been the case with US for the last 30, 40, 50 years. They have generated returns in line with nominal GDP plus dividend growth. In India, that has been the case. Again, it would take me a second to bring up that slide here, but you'll see that that has been very much the case over. I don't know whether that slide's here. Dipojal, that slide's not here. Okay, here it is. Yeah. So here you see, equity returns over the last from 1993 to 23, it's 30-year time period. So certainly more than a generation, so not a short time period. And that's actually a good time period to think of as a long term. Yeah. Long term in equity markets should be measured in decades, in my view, or at least in cycles. A typical cycle is 7 to 8 years in India, has been, can be different. So 92 was a big peak, 2000 was a big peak, 2008 was a big peak, 2017 was a mini peak of sorts. 2017 took a little longer than 8 years. It's at least that's been the last 4 times. It can be a longer cycle, shorter cycle. Nothing is a given in equities. So over a 30-year period, the nominal GDP growth rate was 12% plus. Sensex EPS growth was 12%, and Sensex return was 11.6%. Very close to each other. Going forward, if you believe that India can continue to grow real GDP at 5 to 6% pace, currently in the near term, maybe 6%, longer term, 5%, call it, over the next, say, 20 years, call it closer to 5%. If you assume a GDP deflator, which is similar to inflation of 4 to 5%, then you're talking about, say, 9.5% over the next 20 years of nominal GDP growth rate. You add to that a percentage point or more of dividend yield, you get to somewhere closer to 10, call it 10 to 11% nominal GDP growth rate plus dividend yield. And that would be a reasonable expectation from Indian equity market over the next 10, 20 years. It's impossible to call what is going to happen. It's not difficult. I'll repeat, it's not difficult, but it is impossible to say what will be a return over the next 12 months. It's like, again, going back to the coin flipping example, over 100 coin flips, I think we all can agree that the expected outcome is 50 heads, 50 tails. Yeah. But the next coin flip is either going to be heads or going to be tails. It can't be half heads, half tails. Yeah. In 2 coin flips, 1 heads, 1 tail would be the most likely expected outcome. But it can be 2 heads or it can be 2 tails. But the longer the number of coin flips, the more likely it is that there'll be 50-50 heads and tails. Similarly, the longer the time frame, more likely it is that the return from the market would be in line with nominal GDP plus dividend yield. Shorter the time frame, that is the expected outcome. Like the best expected outcome out of 2 coin flips is 1 heads, 1 tails. Similarly, the best expected outcome from equity market, even in the short term of a year or even shorter term, is that the market return would be in line with nominal GDP plus dividend yield, not over that short term, but the long term expected, which is 11%. So over the next 12 months, our expected return from the market is 10 to 11%. Sorry, short answer, but I gave you the entire underpinning.
Thanks, Prashant. I think we have time for like last couple of questions. Maybe one Rohit quickly. So Rohit, quick comment on the Indian consumption story, and in specific, there's a question on new age businesses. So your thoughts around that, and then Prashant,
say that again.
On the new age businesses for Rohit, Prashant.
The internet, consumer internet names.
Yeah.
Probably. Is that right, Vivek?
That's correct, Rohit. Yeah.
Sure. So, see, the Indian consumption story, we can talk about it for hours, but in a nutshell, it's a long-term story. And like Prashant said, right, what happens in the long run, short-term there could be volatility and variations, right? And in a nutshell, Indian consumption story simply is about, how fast disposable income grows for various cohorts or various, people at various income, buckets, because consumption grows when income grows faster than inflation in your existing consumption bucket. When that happens, that leaves more disposable income in hands of people, and that is used to either consume more of what they're already consuming, introduce new categories to the basket, or consume better of what they're already consuming. These are the 3 ways in which consumption grows. That's the long-term Indian consumption story, because India is under-indexed on most categories of consumption. So India as a whole will consume more, consume better of several categories over a period of time. And of course, these dynamics will differ by income classes. Some for certain income groups, the impact of inflation in the existing consumption basket will be a lot more. Their disposable income would come down. They may be forced for a short period of time to actually cut down on consumption. And that's the dynamic that has been playing out for the last 12 to 15 months, where we've seen disproportionate impact in consumption at the low end of the population. Rural markets have been under more stress than urban. So urban discretionary has been outperforming, let's call it rural staples in a way. But that has started changing with inflation coming down. I think this income inflation gap in the rural markets, as if you look at the syndicate data that is coming out in the last couple of quarters, things are becoming better even in that cohort. So things should look better from, in terms of more widespread consumption growth and not this K, a very, skewed K, that K shaped, consumption recovery that we had seen post-COVID. Then things will become a little more secular in terms of growth over the next 12 to 18 months would be our belief. Now, the second part of the Indian consumption story is that there are players in the market in every consumption category that will shape this story. And as an investment team, that's really what our focus is. Rather than worrying about what happens to the consumption story over the next 3 months, 6 months, it's a long-term consumption story which will play out. The more important part is the winners will be players who will shape this story, right? And this sort of leads me to talking about the consumption and the consumer internet names, the new age tech names in the consumer space. There will be winners from there who will shape this story, because e-commerce is going to be, as we've seen in a lot of other countries, e-commerce will be a meaningful channel. It is growing in certain categories, or has grown in certain categories faster than others. But I think there will be several categories in which e-commerce will be a meaningful channel. It serves a certain purpose in various consumers, consumption or purchase journeys. And again, on the lookout for winners there. So regardless of what has happened in the last 2 years in these names, the euphoria around their listing and then subsequent correction, funding winter setting in, I think there will be more than a few winners in this space. But this will show up in a slightly longer time frame, and we continue to look for opportunities there.
Great. Thank you, Rohit. So Prashant, I think we're at the hour at 6 p.m. One last question, and this is something that I know you've been asked very often. So if someone has plans to deploy funds over the next 12 months, how should the deployment plan be?
Certainly. So unfortunately, I can see there are a lot of other questions that we would not get to here. And I was just glancing through them. Some of those I know, Vivek, you tried and summarized a few questions which are in common. There are many questions that are very different from everything else, so we are not able to address. A lot of questions about the 2 years, both absolute, a lot of people, absolute return 2 year is negative or 18 months is negative and all, which hopefully I see a lot of questions regarding that. Hopefully I addressed the question by when I answered about the fixed income and the equity returns over time, as they don't come in a straight line year after year. We also, our outperformance compared to the benchmark has been the most consistent amongst the, at least the peer group that are amongst the most consistent against any peer group, and the most consistent amongst the peer group of the top dozen names. Yeah. But even the most consistent performer doesn't mean consistent every year. I'd given the example of Dravid and Yuvraj. We'll all agree Dravid is a lot more consistent than Yuvraj. But of course, Dravid did not score 50 runs in every innings of his career. His average was 50. He did get out on a duck several times. He did get out on single digits several times. Yeah. So it is, just as it is not reasonable for investor anywhere in the world to expect equity markets to go up every year, okay, even though they may all agree that equity markets outperform fixed income over time. Similarly, I think it is not realistic to expect any fund manager to outperform every year or every 2 years or even every 3 years. There would be time periods when, as I've shown in my previous discussion, likes of Warren Buffett have had extended periods of underperformance as well. So you have to at any given point in time. Just as in our portfolio, not every stock goes up every year. Yeah. But collectively as a portfolio, we expect them to go up over time, over any reasonable time period. And the reasonable time period is maybe a topic we would take up for the next discussion, because we've talked about a year being not a reasonable time period, 2 years not being a reasonable time period. What is a reasonable time period? Maybe we'll try to address that, though there is no single answer to that. I'm just, Vivek, veering away from the question you asked to answer this question, because glancing through, I saw a lot of questions to this effect. I would also love, by the way, to have the equity markets rally every single day. Why every single year? Yeah, but it's just not something, market's just not something that listens to us. And similarly, I'd love for the team to outperform every single day. Why every single year? Yeah, why not every single day? But that's just not how anybody in the world ever in history has been able to deliver. I'm proud and confident to say we are amongst the most consistent. But the most consistent doesn't mean every single year or every 2 years, is what obviously our a lot of our conversations have shown, and that's a reality. But again, I would highlight it is the most consistent amongst peer group. So to your question now, Vivek, so I just wanted to answer that because it's just glancing through Vivek, since there are so many questions, I thought it's worth a repetition. And Vivek, to your question about how should one invest, look, there's no, I've answered this several times. First of all, as I've said, my personal example, at any point in time I've ever had any money, I've invested immediately. To me, money, and different investors globally, some of the smartest managers may say different things. I have to work as per my belief system. And so I believe over a lifespan of, let's say I've been investing in the Indian market, family or my money, for the last 38 years, over time I've got great diversification. Whenever at my prior firm, I'll get whatever pay or bonus, I'll immediately invest. Yeah, so over time, I've got great time diversification and great returns. Now, the answer, so the answer is any money you have, as and when you have money, you invest, is my viewpoint. Any money that is not invested is under earning, is losing, if you will. Now, there can be some caveats to this. If, unlike in my situation, when money has, say, trickled in over time as my pay or bonuses over the years, if someone, and it is true for many of you, you have your businesses, maybe tech business or otherwise, that you sell or have private equity investment in, and you get one big lump sum payout, hundreds of crores, thousands of crores, or whatever. So then there is a risk associated maybe at one go going into the market at one time. Yeah. And might be too risk. For everyone, you have to feel comfortable sleeping at night. Though you have to know what is the cost of that sleep. If you keep everything in fixed income or whatever you keep in fixed income, not everything, whatever you keep in fixed income, in my view, has a cost. So while it earns sleep, good sleep, it does lose money over time in real terms. But that may be a good trade-off. Sleep is of paramount importance. But if you get at one go a large sum of money, which is huge proportion of your net worth, call it 90% of net worth, maybe there's risk associated with going in at one time. So then it may be better to time diversify it. You diversify across several stocks, several managers. You can also time diversify. So depend on how much it's an insurance you're buying. If you're diversifying it over, let's say 6 months, you're buying 6 months of insurance. You're paying some price for an expected price for it, because in general, equities are expected to outperform. If you're out of the market for 6 months, or a portion of your wealth is out of the market for 6 months, and that's the price you're paying. But people do buy insurance, health insurance, life insurance, and all those are negative NPV, but that reduces a certain risk and hence lets them sleep better. And that's hence they buy insurance. I buy insurance as well. And that's a good thing. So similarly, you can buy insurance by spreading, by diversifying managers, by time diversifying. How much insurance you want is really your call, depending on how much safety, how much you weigh safety versus expected returns. Some can diversify over a 1 year period. Some may want to diversify over a 2 year period. Some may want to diversify over a 3-month period. It's really how much insurance, same as how much insurance is what you want to buy. At a certain point, it doesn't make sense to buy more insurance. Like I often joke. Also, it's a question of how much money are you talking about relative to your net worth. It's like my favorite line is, does Bill Gates, and I know since I've been giving this example, other people have grown richer than Bill Gates, but Bill Gates still, I like to give the example. Does Bill Gates really need to buy health insurance? Yeah. He's got so much money. If he falls sick, he can, buy out a healthcare company. So Bill Gates doesn't need to buy healthcare insurance. His healthcare cost will be so tiny relative to its net worth. It's not worth insuring. So similarly, the amount that you're looking to invest, what proportion it is as a proportion of your net worth. If it is 90% of your net worth, it might make sense to buy insurance and stagger it over time. But if it is 1, 2, 5, 10% of your net worth, may not be worth buying that much insurance, maybe spread over a few days or a few weeks. Sorry, I went a little longer, but Vivek, that's again a question that we get very often. So thought we'll address it once again in an elaborate fashion. But thank you all, everyone, for joining today. I hope you found it useful. I have noted a lot of messages, and thank you so much for those messages about that book. And we will make sure to send and get in touch with you all and send it in a timely fashion. And Vivek, you please make sure that we take
Yes,
down.
Prashant, we'll make sure.
We'll have all these messages.
Yes, we will.
We have taken down those, I guess, email addresses already. Thank you much. Thank you all for joining. Enjoy the weekend and look forward to meeting with you all next time.